When I mention the words simple trading, I'm not talking about just randomly putting on a trade and hoping for the best. You need a trading, hopefully it's a simple strategy, that has an edge, and along with it, risk management under control, and you let the edge play out over time. But simple trading is often overlooked by many traders, and that's to their detriment. Easy access to squawk boxes, news release, trading indicators, forums, and anything trading related. It's resulted in information overload that's not productive. Trading decisions are made only after consulting every indicator and even the cycles of the moon. Have you ever seen a new trader's chart? It is a bundle of indicators, and many given the exact same type of information, which just adds to chart clutter and in the end, analysis by paralysis. So think of this, if a lot of information is what's required for successful trading, then with all of the studies and all the advice that's out there, the number of flameouts should not be as high as it is. Day traders that trade with clutter can cause them to miss the bulk of a price move. And if you must consult 8 different indicators plus price action and chart patterns to validate a setup, when do you place the trade in order to not miss the move? Now, I'm not saying to delete every trading indicator off your chart in order to trade your market of choice with a simple strategy. Sometimes trading indicators can actually frame the price action and give some context to the market. You could learn to trade simply by deleting from your charts redundant trading indicators. Yeah, every trader from Forex to futures to options, they're looking for something to tilt the probabilities of successful trading in their favor. So if you buy into the saying that trading is simple but not easy, should your trading strategy approach the market in that manner? Should you not strive to make things as simple as you can to trade but not remove important pieces of information? Yes. When you use too many variables for your trading plan, it can be hard to stay consistent each time you look for a trading setup. One main rule that we follow at Netpicks is that if your trading strategy has a verifiable edge, and it should, before you ever trade the strategy, then you must apply the strategy and the plan consistently over time. Now, how do markets move? Well, here's a simple trading approach. And this is a great way to develop a simple approach to your trading. And if we take a high-level view, markets trade in a trading range. Markets break out of the range and trend, often with momentum. Reversion to the mean when price extends too far and too fast. So let's take a look at these 3 views of the market and see how we can take a simple trading approach and not get bogged down with redundancy. So how do you know if a market is in a trading range? Well, a simple price action approach, taking into account lower highs and low in a downtrend to higher highs and lows in an uptrend. When the stair-stepping stops, consider yourself in a trading range. You could also consult a moving average, and when price is whipping back and forth around the average, consider that a trading range. And this is a 20-period simple moving average. It's applied to the daily chart of the Euro-US dollar. It doesn't matter what chart we use. And the red lines indicate swing highs and lows that you can see where the price uptrend of higher highs and higher lows ends. Now, price is just whipping back and forth around the moving average, and on this time frame, we are clearly in a range whether you use price action or the average. Now, breakouts and momentum. Trends have to begin with a breakout of a trading range, and although we can see that the actual breakout and oftentimes the probability of a breakout, we can use momentum to show us that, hey, something has changed in this market. And I put the MACD indicator here using that 310 settings from Linda Raschke. That's become pretty common on many charts. And I've added a few notations of the chart, and I think they're valuable. And we're going to use the same chart that we just looked at. We can see a double top is formed in price, and the MACD indicator has registered a lower high than the previous. So this is hinting that momentum is not as strong on this second push. There is a steady decline in the highs of the indicator at number 2. At number 3, this was a momentum low that was lower than any previous low in recent market action. And this is a red warning flag that we are seeing a momentum shift, and we should not ignore that. And this is where the price actions start to show a range price pattern. And number 4, price broke out and the MACD broke to new lows. Using 2 indicators like this for a simple strategy actually follows how the market moves, and it can form the basis for a trading setup. Looking for a pause in trends with consolidations aided by a moving average and the resumption of momentum via a breakout in the MACD, that's a sound approach. Mean reversion. So what we're looking for is a market to be extended from an average price and then for a snapback to occur. And this can be an event that you trade or you just use the reversal of price as information. Either way is fine, just keep it simple. Do not read too much into price movement. Markets are going to do what they want to do. Simple trend channels can help see a market that's ripe for mean reversion as price moves in a rhythm. The first channel is broken with momentum and we're on to another channel. And this is a typical price movement where you get a channel, an impulse move, channel. When price hits the top of a channel in an uptrend, you may look for an exhaustion in price to take a counter trend trade. A better price action sign is when price breaks the top of a channel and pulls back like we see in the second channel here. You can use the touches of channels as trading signals, but ensure you have a full trading plan to guide you. Support and resistance. Too many lines on a chart that mean nothing. And that's what many traders do as they use horizontal lines and diagonal lines. So the question is, how do you even know that your lines are no better than random? Support and resistance overuse has the same effect as too many trading indicators. Analysis paralysis. If you decide to not take a trade due to a diagonal trend line or some horizontal line where you connected a few highs or lows, how do you know you're using something that has any merit? You don't, unless you stick to obvious zones on a chart. There are no hidden levels in the market, and even if there were, hidden would mean that not many would see them, and the only way support and resistance works is if enough flow happens at them. The most obvious areas where flow can happen are obvious zones on the chart. And to narrow that down, look for a bundle of price action at certain areas. Notice the cluster of trading activity I've marked and extended. Price reacts in the future to those zones, and it's in these zones that you could use a simple approach to trading and look for breakouts and momentum, as we've already discussed. See how many you can find that have had reactions as an exercise. And I'm going to touch on one way that I personally draw support and resistance, and it's not at extremes, it's inside the extremes. And the drawing here shows 3 bars with the middle one being the extreme. In this chart, I look below or above directly adjacent to the middle bar. Think of a head and shoulders pattern where the 2 sides are lower than the extreme. And connect out from there. It can be subjective. And for a more simple approach, you can use the extremes and perhaps bring the lines inside the extreme candlestick so you're not just on the high or the low. Only you can decide if the profits and the results that you're getting with clutter or convoluted trading strategies can be improved with simplifying your approach to trading. An exercise that you can do is look through your last run of trades and determine whether you used or you ignored some of the information your chart gave you. If you did, downsizing your approach may lead you to better results, and if anything, less information overload. So go back into your charts and go back to this video about how markets move and base your trading strategy around those mechanics. And you may find that simple trading suits you a whole lot better.